Here's a number that should bother you a little. To retire in the top 5% of Americans, you need a net worth of around $3.5 million. For folks 65 and up specifically, the line sits closer to $3.2 million. Now here's the number that should bother you more. The typical American in their early 60s has about $390,000. So the gap between normal and top 5% is roughly 9 times over. That sounds impossible. It isn't, and I can prove it isn't because the people who actually get there are not smarter than you, they don't make more than you think, and most of them never picked a single hot stock in their lives. What they had was a portfolio, a specific mix of stuff put together in a specific order, left alone for a long time. That's the whole game. So today I'm going to walk you through exactly what that portfolio looks like, how it should change as you age, and the handful of mistakes that quietly keep regular people locked out of that top tier. Let's get into it. So the whole portfolio comes down to 3 buckets. That's it, 3. Once you understand what each one is for, the entire thing gets simple and you can run it for 30 years without losing sleep. Bucket 1, the growth bucket. This is the engine, and it's where most top 5% retirees built the majority of their wealth. Not in some clever trade, in this bucket, running quietly for decades. For most of your life, it's the biggest piece of the portfolio by far, and it does one job: grow your money. It's built on broad, low-cost index funds, a total stock market fund, an S&P 500 fund, something that buys you a tiny slice of basically every important company in the country in one shot. 2 reasons this is the foundation. First, cost. A good index fund might charge you 3 cents a year on every $100. A lot of actively managed funds charge a full $1 or more, and decades of data show most of them still lose to the plain index. You're paying more to do worse. That's the whole pitch, and somehow it's a billion-dollar industry. Second, it just works over long stretches of time. Historically, the U.S. market has returned around 7% a year after inflation. I have to be straight with you, though, that's a historical average, not a promise. The market drops. It fell about 4.6% just in the first quarter of 2026, and this year's been a rough ride. Anyone who tells you a specific number is coming is selling you something. But the principle holds. Own the whole market, keep your costs near zero, and let compounding do the work over decades. One thing worth adding here, a lot of people want to bolt on an international fund too, and that's reasonable. The U.S. has led for a long stretch, but it won't always, and owning a slice of the rest of the world spreads your bet. You don't need to overthink it. One total U.S. fund and one total international fund covers an enormous amount of ground. The mistake isn't picking the wrong index fund. The mistake is owning 12 overlapping funds that all hold the same companies and calling it diversification. Simple beats clever here almost every time. Bucket 2, the income bucket. This is the bucket that starts to matter more as retirement gets closer because its job is to turn your pile of money into a paycheck. And I want to be careful with the wording here because this is where a lot of finance videos get sloppy. The goal isn't dividends specifically. The goal is income-producing assets, and there are 2 legit ways top retirees get there. One camp owns dividend growth stocks and funds, solid, profitable businesses that mail them a check just for holding the shares, no selling required. The other camp just owns broad index funds and sells a small slice each year to fund their life. That's called the total return approach, and the math works out about the same. Neither one is wrong. A lot of top 5% retirees actually do both. I lean toward the dividend growth side for one psychological reason. It's easier to stay calm in a downturn when checks are still landing in your account versus having to sell shares while the market's red. But understand the principle underneath it. You're building a stream of income you don't have to work for.
If you go the dividend route, the key isn't just paying a dividend, it's growing it. You want companies that raise their payout year after year because inflation doesn't stop when you retire. Groceries, gas, everything keeps creeping up. A company that bumps its dividends 6 or 7% a year is effectively handing you a raise after you've stopped working. Your income climbs while your effort sits at zero. That's the part that makes retirement actually sustainable instead of terrifying. Same honesty as before, none of this is promised. Companies cut dividends when times get tough, so you don't pile everything in here, and you definitely don't chase the highest yield on the screen. When you see a yield that looks too good, like 12 or 15%, that's usually the market warning you the payout's about to get flashed. High yield is a flashing light, not a free lunch. As you get within 5 to 10 years of retirement, this income bucket grows, maybe to 30 or 40% of the portfolio. You start caring less about the number going up and more about the number paying you. That shift, by the way, is one of the quiet markers of people who actually make it to the top tier and stay there. Bucket 3, the safety bucket. Last one, and it's the boring one on purpose: bonds and cash. And here's the thing, nearly every top 5% retiree eventually builds this bucket, because once you've got real money, protecting it quietly becomes more important than squeezing out the last bit of return. Getting rich and staying rich are two different skills, and this bucket is the second one. This bucket barely grows, nobody gets excited about it, but it does the single most important job in retirement. It keeps you from panicking at the worst possible moment. Picture this, you're 68. The market drops 30% in a few months. If everything you own is in stocks, you've got two options, and both are bad. Sit there and watch a third of your life savings evaporate, or sell at the bottom and lock the loss in for good. That second move, selling in a panic, is the most expensive mistake retirees make, and it's heartbreaking because it's so avoidable. The safety bucket fixes it. You keep a couple years of living expenses in something stable. When the market tanks, you live off that and you leave your stocks completely alone to recover. You're not forced to sell anything at a discount, you just wait it out. That breathing room is the entire reason this bucket exists. A common rule of thumb is to hold roughly your age in bonds, so a 60-year-old might keep 40% there. Honestly, that's a bit conservative for people who are now routinely living into their 90s, but the direction is right, more safety as you get older. Now let's look at the portfolio by age. Let's make this concrete, because this is the actual blueprint top 5% retirees followed, not the exact percentages to the decimal, but this shape, this glide path. The usual disclaimer first, I'm a guy on YouTube, not your advisor, so take this as the shape of a plan, not a personalized one. Your 30s and 40s, the build years. 85% growth, 10% income, 5% safety. You're almost all growth bucket, and that's exactly how the top 5% crowd started. The reason is simple, you have time. If the market crashes, it doesn't touch you because you're not spending this money for 20 plus years. A crash just means everything's on sale. This is the decade where savers and spenders split apart, and it comes down to your savings rate, not your salary. Max the 401k. The 2026 limit is $24,500, and don't let your spending climb every time your income does. That last one quietly sinks more retirements than any market crash. Your 50s, the acceleration years. Now you're around 70% growth, 20% income, 10% safety. Catch-up contributions kick in. After 50, you can add an extra $7,500 to the 401k and another $1,000 to your IRA. Use every dollar of it. This is your last long runway before retirement. And here's the encouraging part. In this age group, most of the gap between a good portfolio and a great one comes from investment growth, not new contributions. The money you already put in is finally doing the heavy lifting. Your main job is to not interrupt it.
Your 60s, the transition years. 55% growth, 30% income, 15% safety, plus that 2-year cash cushion fully built. Now the question flips. You stop asking, how do I grow this, and start asking, how do I make this pay me without running out? This is also when you think hard about Social Security timing. And one tip most people sleep on, waiting to claim until 70 instead of 62 can raise your monthly check by more than 70%. That's one of the best deals in personal finance, and it's just sitting there. Notice the pattern across all three stages. The portfolio slowly turns from grow, grow, grow into pay me, pay me, pay me. That gradual shift is the strategy. It was never one perfect move. It's a slow, deliberate rebalancing over decades. And one layer most people completely skip. Where you hold each bucket matters almost as much as what's in it. Your high-growth index funds and your dividend payers ideally live inside tax-advantaged accounts, your 401k, your Roth, your IRA, so the growth and the dividends aren't getting taxed every single year. $1 in a Roth is worth more than $1 in a regular brokerage account, and a lot of people never realize that until it's too late to fix. So as you're building these buckets, think about the container, not just the contents. The mistakes that keep you out. A great portfolio is only half the job. The other half is not blowing yourself up. And this is usually what separates the people who reach the top 5% from the people who had the exact same plan and didn't. Here are the 3 ways regular people sabotage themselves. 1. Waiting for the perfect moment to start. I meet these people constantly. They've been waiting for the dip since 2014. They've got a pile of cash in a savings account, barely keeping up with inflation, and every year they wait, they lose ground. The studies are about as unanimous as studies get on this. Time in the market beats timing the market. The best moment to start was years ago. The next best moment is the day this video ends. 2. Buying hype. Somebody's cousin has a tip, something's trending. You throw money at it because a chart looked good and you got a feeling. That's not investing, that's gambling. And there's nothing wrong with a little play money as long as you call it what it is. But the core of a top 5% portfolio is boring index funds and quality companies held for decades, not whatever's loud this week. The people who made it there were disciplined, not lucky. 3. Never rebalancing. This is the one that got me. Years back, I let a single position run because it was winning, and I figured I'd ride it. It grew until it was something like 40% of my entire portfolio, one company. And then it stopped winning and it fell hard, and I learned a very expensive lesson about concentration. A portfolio that's way out of balance is fragile even when it looks like it's crushing it. Rebalancing fixes that, and it's almost embarrassingly simple. Once a year, you check your 3 buckets. If one got too big, you trim it back to your target. It feels backwards. You're selling some of your winners to top up your laggards, but that's just selling high and buying low on autopilot, and it stops you from accidentally betting everything on one thing. Pick a date, your birthday, New Year's, whatever you'll remember. Do it once a year and then go live your life.
The part that actually matters. Everything I just described is not complicated. You could build the entire portfolio with 3 or 4 funds. The knowing was never the hard part. The hard part is doing it for 30 years without flinching. The top 5% isn't full of geniuses. It's full of people who automated their investing, kept their costs low, didn't sell in a panic during 4 or 5 genuinely scary crashes, didn't blow their savings on stuff they barely used, and let 3 boring buckets quietly compound in the background of an otherwise normal life. That's the secret. It's not flashy, and it absolutely works. And I'll say it one more time because it's important. Nobody can promise you a specific outcome. The market does what it wants, and there's risk in everything, including doing nothing at all. But the structure, a growth base, an income layer, a safety cushion, rebalanced once a year and fed consistently, has carried an enormous number of ordinary people exactly where they wanted to go. So, before you click away, do one thing for me. Actually, do it for you. Take 10 minutes today and look at what you own. Figure out your 3 buckets. How much is in growth, how much is in income, how much is in safety, and be honest about how much is in stuff you bought on a feeling. Then pick the target mix for your age and set up a single automatic transfer so it keeps happening whether you feel motivated or not. Motivation fades. Automation doesn't. That's the whole thing. The portfolio we talked about today isn't complicated. In fact, that's exactly why it works. The challenge isn't understanding it. The challenge is sticking with it when everyone around you is chasing shortcuts. Because retirement wealth isn't usually built in a moment. It's built in thousands of ordinary decisions made over decades. And one day, those ordinary decisions add up to an extraordinary result. The market doesn't reward the smartest person in the room. It rewards the one who shows up, keeps it simple, and refuses to quit. Be that one. Run anything big past a fiduciary who can actually see your full picture before you act on it. Thanks for watching. If you enjoyed this video, give it a like, subscribe for more retirement content, and I'll catch you in the next one.